Hey everybody, it's Erik, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories Village Global. I'm here today with Alex Bangash of Trusted Insight. Alex, welcome to the podcast.
Thank you for having me, Erik.
And we're here to continue our series on LPs and how that business works. Alex, why don't you give an introduction to Trusted Insight as well as your background and how you became to be an LP in the first place?
Let me give you my background. I'm an engineer by background, spent 10 years at Bell Labs in the algorithms department. And then I embarked on an optical networking company, which happened to be at the wrong time and wrong place. And then thought maybe, it's probably better to build a portfolio and not take market risk. But no LP, no VC was hiring at that time. And so instead of jumping into the VC world, I jumped into the LP world and kind of helped LPs build their portfolios. And then kind of I guess the right time, right place, and got ridiculously lucky to work at the very beginning with folks like Ken Howry and Peter Thiel when they founded Founders Fund, Subrata Mitra when he founded, and Prakash when he founded Excel India, and so many iconic, Gary Tan and Alexis Ohanian Harshtagar when they worked at YC. So literally at the founding of those firms, and then also help early investors in first round and founders lowercase baseline. So
yeah. And then later SaaStr.
Yeah, and now SaaStr and a few others. So.
Yeah. So when you got in the business, how have you seen the business evolve since when you first got in? Just from a macro perspective, the LP world from when you first started, early 2000s?
Yeah. So it's like, I think about 2003. So I just kind of tell you about, maybe a little about myself and how I look at it. So I'm always an outsider. So I'm kind of like the outsider insider, and I always even now bet on the underdogs and against the incumbents, right? I'm always fascinated by the disruptors, right? So I'm never rooting for what they call sustaining innovation. I'm saying who is going to come and disrupt the incumbents. So right from the beginning, some of the folks that I worked with in the very beginning, they were disrupting the models that had been there in the past. And they started by being Founders Fund, of course, first round. They started by being very founder friendly, and the common theme of all these firms, if you look at it, YC, Andreessen, first round, they're all entrepreneur led funds, right? So initially this is, and I like to say this is like, in every other asset class, it's the manager that picks the securities. You basically are picking managers based on their security selection skill. In venture, it's inverted. It's the security that's selecting the manager. And to the extent that the manager is selected, they can do the selection. So Sequoia didn't pick WhatsApp. WhatsApp picked Sequoia to the exclusion of everybody else. So that's kind of what I saw initially, but then there have been waves, so it's funny. I mean, those waves, I think the biggest change, which has actually, and this kind of started at around the same time. And I think that there've been many fundamental structural change, but the single biggest thing that has happened is the cost of startups coming down, right? So all of a sudden, the first and second order effect of that is that venture now is become, or entrepreneurship has been is accessible to everybody, and it's accessible globally, and that's given rise to a Cambrian explosion of startups. Right, UiPath is coming from Romania, and Spotify is coming from Stockholm. And even though you and I are sitting here in San Francisco, and we can see this is the center of the universe, but actually it isn't. Right, Ethereum wasn't invented here, and blockchain wasn't, and and some of the coolest things are going to be developed. So I think that's what's the underlying change.
Totally. And if we had to compare with, say, someone like Michael Kamat-Sandana, who's focused and thesis on micro funds with very concentrated portfolios in different sectors, I believe. How would you compare and contrast how your thesis differentiates from that or other LPs? Would you say?
So I really don't look at myself as an LP. So I'm not going to, first of all, I don't know anything about his thesis or his thing. So I would not be. So I am looking not for funds. I'm looking for things that disrupt venture, right? So in some sense, perhaps this goes back to my training as a computer scientist. My first job was like, how do I, kind of eliminate myself, whatever, I think the first job that I had on the manufacturing floor, my boss gave me this assignment and he said, okay, make this. It was a computer manufacturing line. He said, optimize this manufacturing line. We're spending 2 hours building a microcomputer. And by the time I was finished with the line in 6 months, it was taking about 11 minutes to build the whole microcomputer, including the tests. And so the people would come up to me and say, well, Alex, you are completely eliminating our jobs. So I think I look at it the same way. I think we should eliminate the role of the VC. So the things that I'm most interested, for instance, are in platforms, API-based funds, and actually studios. So, and all three of those, they're taking advantage of structural changes in venture capital. So, Erik, a good point, and I won't compare myself with any VC, LP or VC, but I think most of our industry is centered around this myth that there are good pickers. Okay. And that these good pickers are now, they are in certain networks, or they are in certain, or they are, they are apprenticed by certain people and they become very good pickers. And good examples of that, Peter Fenton is a great picker, or XYZ is Fred Wilson is a great picker. And there were in some of the past generations that was true. And it also had to do with the brand effect, right? So there was Benchmark built a brand and Greylock built a brand, and through that brand halo, they were able to get the best thing. But today, the structural advantage has all but disappeared, and it's so anachronistic. It's like when somebody comes and tells me, and almost, 10 people a week pitch me, they say, Alex, I want to build the next benchmark. And I almost cringe. That's like saying, Alex, I want to build the next Sears or the next JCPenney, right? You should build the next Amazon. You should build the next YC, the next AngelList. So I think that this, you're increasingly going to see there is no next David Swenson. The next David Swenson is a neural network, right? The next Peter Fenton, there is no Peter Fenton at YC, right? There is no one, everybody is replaceable in YC. Everybody is replaceable in Entrepreneur First, right? It is a machine. And similarly, so I believe in structural changes and I believe in disruption. So I think all of these people, and you can name LP after LP after LP, LPs sell access. VCs sell access. I want to disrupt access. I am saying I want to democratize access, either through platforms, and I want to democratize access through direct access to entrepreneurs. And that's what studios are. So, we can go deeper into that.
Yeah.
So,
I want to, but first, so I want to go deeper in platforms, studios, API driven opportunities. But first, I want to continue the sort of historical trends. So Founders Fund, first round, sort of had this, we sort of think it's trite now, but founder friendly was new at the time.
Yeah,
right?
Very new. There was, Sean Parker was, I think he's probably one of the most creative people I've worked with. I mean, he came up with the FF shares, right? And, which is like taking, giving founders some liquidity so that they could go for the home run, right? And now it's so common. But at that time, that was sacrilegious, that was,
And so what changed structurally that made it less about picking and more about the platform? Was it just the influx of capital and now entrepreneurs could choose from a whole set of firms, or?
I think there are many, many, many factors, but the single most important factor is just the cost of starting something, right? That's the only, it's like when you go to YC demo day, right? And there will probably a Dropbox there this time. There's some great companies, but how are you going to pick? There are 250 of those companies, right? And it doesn't matter. It might be in a different sector. It might be in a different geography. It might be in LATAM. One of those most recent companies was Rappi, and
which I invested in.
Huh?
I invested
there
in.
You go.
Yeah,
Erik, you're doing a good job. Yeah.
If there's more startups, wouldn't picking ability be even more important?
No, because you can't, it's not humanly possible to process this. That's the point. I mean, how would you have found UiPaths, right? I mean, two of the best funds today are, I'm not going to name, right? There's some that are in China. There's some that are actually in Europe. People don't know, right? In the last 3 years. And it depends on where this next big thing is coming from. So unless you built a platform, right, you aren't catching, a broad enough swath, at least at the early stage. And the biggest change that has happened, I mean, take your top 20 firms, right? 60 out of the top 20 firms are over $2 billion. $2 billion, right? So you tell me that looks more like private equity to me. That doesn't look like early stage venture capital. And that's when paradoxically the cost of starting companies has gone down.
Right. So what's going to happen in these funds?
I think they will do fine. But they will do great private equity-like returns, right? So, those that are intellectually honest, tell their LPs that, look, we will get you venture-like returns if we find the next Google or Facebook or Uber, right? And barring that, even a decacorn doesn't get them, if you get in at 2 billion, even a decacorn doesn't get you a 10x fund or a 5x fund, right? It gets you a 3x fund if you're lucky.
Yeah. So we talked about you need to build platforms, but you invested in first round, which is a platform. But baseline is more of the sort of.
But that was a time in lowercase. I mean, lowercase was I remember visiting with Chris Sacca in 164 South Park. He at that time had 1.23 million Twitter followers. So it's not, it wasn't a happenstance that he did Instagram and Uber and so Kevin Systrom, Travis, everybody wanted Chris because he was the influencer's influence. In fact, Shakil Khan, who's was the first Spotify business development person who came here, he's the first person he wanted to meet was Chris, because Chris was the influencer's influencers to bring Spotify to the US. So I think he had created a special advantage for himself. But you have to understand that was a point in time, right? So today I think there is, and that's what you've seen, there is no dominant super angel today. Right? It was a point in time, and that point is fast. It doesn't matter how, because, unless you build something like Jason Lemkin has built in SaaS, or unless, in cloud infrastructure, or unless, you're not going to be as desirable to everybody across the board.
Right. It's become much more either sector focused or geo focused, or you have to specialize.
Exactly. It's specialized, and it's just, it's just, and then now there are, whereas at that time there were, tens of these folks, now there are, literally thousands, not even just hundreds, and now with more liquidity at Airbnb and Uber, it's going to add to those.
And so when did you see that rise of platforms happening? You had Lowercase, you had Baseline, First Round, Michael Deering, et cetera. When did you see sort of the first platforms emerging?
Well, YC, it actually took me 3-4 years to get to, meet Gary and Alexis. And, one of the things that we see now, there's more attention to women, but those of you who are astute history buffs of venture capital know that YC was actually Jessica Livingston's idea. So I got to meet Paul a couple of times, but I could never engage with him. So I actually ended up engaging with Jessica, and then Jessica introduced me to Hudge and Alexis, and then Gary, and then Gary really made things happen. And so I was very lucky to be really early involved in that. But it took me like 2-3 years to get to it. So, but still, I was still way earlier. That's 2011. So, but I mean, even then, I think the first, my friend, Jason Friedman from 42 Floors had connected me, had actually told me, he was like very emphatic. He's like, Alex, it's almost like, these platform effects, these things are almost like, they're like, there's religions, there's cults, and, these things are almost a little like that. And YC is a little like that, and Jason said, well, Alex, YC is the thing. And, he had done Flightcaster, and then he introduced me to James Lindenbaum. And then James, this is 2010, and James is, I still think, I'm very lucky to be involved with Heavybit as well. And, at that time, he built an iconic cloud infrastructure company in Heroku. So James was actually, my conviction was like, yeah, YC is going to be really big. Heroku is going to be really big. And it actually is. I think, even machine learning will be delivered through APIs, and that also informs my thesis of API-based ones.
Yeah. And so what did YC bring what was the innovation they really brought to sort of the platform ecosystem that you could do venture differently, that you could do it in a batch model, that you could get outsized economics, that you could have network effects?
Yeah, all of those, right? All of those, right? And I think also, so I also believe that, in all these things, you need missionaries. Right? There are so many mercenaries, and people talk of psychopaths and mercenaries in our business, right? Even though I think, on a relative business, I think our business, VC is much more benign and benevolent than, say, hedge funds and, private equity. But still, there are, cases, and I think it's the missionaries that really win. So I think I've been very lucky to work with those folks that really take a very long term. And actually, those of you who, if you have read Clayton Christensen's work on disruption, and it's not just long term in terms of kind of long-term thinking, but also putting less focus on these, quick return on investment, right? On IRRs, on quick thing, building something for the real long term. And that's why, and that's what I think YC was really.
Yeah. It's interesting. I was talking to someone who was at Sequoia. I was involved when they were doing the, sort of broadly involved. And they were saying, hey, they're sort of saying this, kindly, but they were saying, hey, Sequoia helped Airbnb, significantly longer than YC did, right? They, Airbnb went to YC for 3 months, and then Sequoia, invested, was on the board, and continued that relationship for 10 years. And yet when the Airbnb founders talk about, who's been most helpful, they often say YC, or the first name that comes out is YC. And it just shows sort of the power of believing in someone when no one else believes in them, or of being first and putting someone in business that, and of the power of, as good as Sequoia, was for them, a sort of powerful experience and community, between what you said about religion and cult, that YC created, that gave them not only undue economics, but also not undue, but extra sort of credit in some sense that, allowed the next the network effect to happen. Airbnb, Stripe, all these companies being like, YC helped make me what I am today, and I'm grateful to YC, which then spurred the next generation.
So, exactly. And I think and I've just in the last 2 months, I met 2 very well-funded startups. And one is a former YC alum and one's not a YC alum, but his last company, who's not a co-founder, maybe he was like a co-founder. And, both of them mentioned it's like, oh, well, we don't need YC for fundraising, but we want to go for the network of founders that we can. So I think it's, it's really amazing. I think, Entrepreneur First is on a different trajectory. Also, I think the best funds are the most authentic funds, right? So, if you look at the copycat models, they've always failed. They've never even reached, 1/10 and I'm not going to name the things, but anyone who has tried to copy, right? So I want to be the next AngelList, or I'm going to be the next, that's why like EF is so authentic, right? They're doing what YC is not doing, right? Which is matching founders. And now many people are trying to copy EF, but they're so far ahead. And then and it's in their DNA. Like they're not copying somebody. They saw that problem and they solved it, right? And it's the same as like, we're lucky to work with Jason Lemkin again. He's like so authentic, right? It's like no one questions that Jason really cares about his community and really cares about the founders, right? And similarly with Gary, and that's one of the reasons and after a while what happens with most LP land is you start butting heads. Like when you invest in multiple funds, they start competing with each other, they start, right? But I think one of the reasons why I like the studio model is because the studios don't compete with each other. They're each is investing around a founder.
Yeah. So let's talk about the studio model. Talk a little bit about how the studio model has evolved and where you see it now.
What's really amazing about the studio model is, for the first time ever, it is giving this, and you talked about, whether YC everybody adds value, right? Good people add value. Sequoia adds value, YC adds value. But actually, and I think the only person who's been, said this publicly, or at least when I know of this, we know Coastline says most VC detract value, right? They don't add value. And if you look at it, honestly, it's the entrepreneurs that are adding value. But on the financial benefit side, the VCs have a portfolio, right? That's why they always want people to swing for the fences. They have a portfolio. The LPs have a portfolio. But why is it that the, entrepreneurs can't have a portfolio? Well, actually, if you look at it, we are now at a time where, some of the best ideas have come by, folks, an Elon Musk, a Jeff Bezos, a Max Levchin,
Garrett Camp from Uber. Garrett Camp
from Uber, right? Garrett built Uber while he was, working on, StumbleUpon, right? And actually, I think Travis wasn't even involved in the first year or so, right? And most of these successful founders, they have many, many ideas, right? And once they have the wherewithal, and once they have the thing, they can definitely do, more things. So I think in some sense, the reason why studios are so important now, and I'm going to take more from the entrepreneur's perspective, right? So I don't think a studio, an operator that's never run a company can build a studio. Right? So I think I think a studio is, if you have an amazing founder, that founder can then surround themselves with many other co-founders and build a shared infrastructure, and then build a portfolio of companies. And in some sense, it completely disrupts venture because, now, you're not going to a VC to build a portfolio. You're going to an entrepreneur to build a portfolio. And then, what is also amazing is that, the entrepreneurs, done correctly, I think many of these studios, they are fraught with conflicts of interest. But if done correctly, you are able to get great alignment of interests between LPs and the founders. You're also able to get much, much higher upside both for the founders and for the LPs. And by the way, the VCs don't get completely replaced. the VCs get displaced. And which is great for them because the VCs have no, all the top VCs, they have multi-billion-dollar funds. They don't want to write $2 million checks and $10 million checks. They want to write $50 or $100 million checks. So they just come in later and, the LPs get to work directly with them.
Yeah. The ways you're trying to disrupt, venture, platforms, studios, API, the studios, you mentioned that there are 3 different generations.
Oh, yeah, I didn't answer that question. Yeah. So I think the evolution has been, I think the studios, initially started with more, consumer-like models. And, a very good example is, what the Zammer brothers did with Rocket Internet. They would never take, any business model risks. They just say, oh, if this worked in XYZ.
Airbnb works in US, but in Europe.
Yeah, exactly. And I think Groupon and Zalando and then they've done those multiple geographies, and they've been, very, very, very successful with some of them, some of the models. And so I think that was kind of the first wave. Berlin wouldn't have been Berlin without the Zammer brothers, So that was kind of the first wave. And of course, there was, in the .com era, there was even, something, preceding that with Idea Labs, where, Bill Gross and even Bill Trenchard and Howard Morgan and others, worked. But what's actually happening right now. And that wasn't, then kind of the second wave was more, the more kind of thematic studios that we saw, come up. And, that includes, like BetaWorks and High Alpha and Science and others. And, they've had really good successes. Sciences, has already had $1 billion exit, Dollar Shave Club, and, Mammoth is doing really well. And of course, you can't lump all of them together. I think that the second wave of startups, they got really, really good at distribution. So I think if you look at, I think, Atomic is, I think, probably a really good example is like, Atomic's probably the best studio out there, in distribution, and could very well become the very best venture fund, because it's all distribution. So every one of their companies is, there's a long line of VCs looking to invest in their companies. But I think the third wave that we're seeing, so copycat distribution, and then I think the third wave we're seeing is building intellectual property. So as you have this renaissance of deep tech, for the first time, whether it's computational biology, AI, that's becoming relevant across so many industries, right? It's not just autonomous driving, medicine, etc., farming. So you can now start building IP at the studio level and using shared algorithms and shared data sets, and actually, across different companies. So I think that's something which is very nascent, but also very, very exciting. So I think that will be the third wave. And I think those will be, so I think that's kind of something which is now giving, it's again, you're getting direct access to the entrepreneurs, right? I mean, if you look at it, somebody said Jeff Bezos is, one of the best allocators of capital. And he is, right? I mean, he built AWS, which had nothing to do with his e-commerce business, into one of the biggest cloud infrastructure companies, right? It's bigger than Salesforce, isn't it?
Let's also touch on API, opportunities. So what is the opportunity there, and what might that look like?
So, I get pitched like 100, I've been pitched 100 machine learning funds. And actually, I don't think they're that interesting because they're so obvious, right? And it's like, I sit in front of I sit in front of a screen and boom, I scrape XYZ, this blogs and, different hackathons, and it tells me which the best company is. I think it's too hard, right? I think today, every tech company is built on a tech stack. And I think if you can measure the activity at each point on that tech stack. For instance, and I'll take a simplistic example. For instance, Uber is built on a Google Maps, a Twilio, a Stripe, and a segment and a GitHub. So if you could measure the activity, then at each one of those levels, then you would be able to tell which startup is taking off. And, there's a famous story of how WhatsApp got funded, right? So WhatsApp was actually first discovered by Andy Rubin, when he was, because it was it was the most downloaded app on Android. And he actually had the Google corporate development chase them down and, try to buy them. They gave him, I think, one offer, and they gave him $100 million offer. And then WhatsApp turned around and so that's how WhatsApp was discovered. And I think that's how most new apps, that's why I think picking is now less relevant, right? The discovery will be through these apps. So if I think at one point GV said they were using Google Analytics, but I don't know whether they still do, or at least they don't say publicly, whether if AWS Stripe could measure, they would be better pickers than anyone, right? So I think now, we're trying to find those companies whose APIs are being used to build the next generation products.
Yeah. Let's go back to platforms for a bit. So I'll give my sort of outsider's brief history of, and then I want you to correct me or add or edit to it. So you sort of first round, that generation offered, platform as community and, seed firm with sort of extensive platform team and services. You had sort of Andreessen, which sort of scaled that out to, 10x that in terms of size and, not just we're going to help you with talent, but we're going to help you with customers. We're going to help you with sort of every element of your business, sort of like CAA for, a VC edition. You had YC, which sort of had a different structural advantage in terms of the batch, in terms of the set offer, and in terms of the network effects that built on top of that. Then you had, and we're going out of order here, but Social Capital, which tried to do multi-stage and multi-asset. Andreessen also doing that as well now with bio and crypto. On a different angle in terms of platforms, you had AngelList, which tried to do a more democratize the asset class. I want to hear your thoughts on that. And then, SignalFire, which is them and a few others have tried to do a more data-driven approach to picking and selection and supporting. Is that a fair summary, or what did I miss, or what would you edit to that summary of sort of the last, decade or so of platforms in VC?
Yeah, I think, I think you're missing one of the biggest one, which is entrepreneur first, So I think there's probably a small twist to it, right? So I think you can build community and you can build network effects. I think also, like in the past, we saw the PayPal mafia. That's why most people are now looking for the mafia. And I think that's a fool's errand as well, because those mafias now have been replaced by these platforms. They are much stronger. The network effects there are stronger than the affiliation that you feel to any particular company, right? I think what kind of, I don't think you've missed a lot. I would probably, I have strong opinions, probably disagree with a few of the people that you mentioned, and I'd add a couple of those. But they're all really good people and all innovative. I think it's one is the structural innovation, and the second thing, which is as important, is the investment mousetrap. Right. So the innovation in YC was not that they made a class but that they were able to get 7% of equity of every company. Right. That was the innovation. Right. So I think just building a platform and giving services and all those things don't work if you also don't build a better mousetrap. Right. So, I think we're seeing the same kind of innovation in studios, the same kind of, there is now a structural.
Let's go through a few of those platforms. So one is YC, we talked about a bit. I think it is interesting. I mean, to your point about, Warren Buffett has this line about franchise where, a franchise where even a team with poor management or no management, can run it and it'll still be great. And of course, YC's team is super great, but they did just lose Sam Altman, and it seems like it's business as usual at YC.
Well, and Sam's amazing. And so Michael Siebel's amazing, right? There are a lot of amazing people, but, Paul Graham was amazing. Totally. They lost Paul Graham and they didn't lose
Whereas if Benchmark lost Bill Gurley today, it looks like that would be pretty big.
Well, you said it.
So I mean, by the way, the Sears analogy implies, and we can take this out if not relevant, that they might be gone in 20 years or so.
What's the fundamental issue is and this is the structural change, right? So another thing is like, if the world is so noisy and the startups are so hard to pick initially, the benchmark model does not work because you can only be on 12 boards. Right? You can only be 12 boards in 2 continents max, right? You can't be on 12 boards in 4 continents, right? So I'm not saying, and I'm saying because Benchmark is a great firm, right? So, and then also you're not structurally, many VC firms try to work with YC, right? But it was like drinking from a fire hose, right? How do you process so many startups? You can't meet all those startups. You can't, so I think that's why, it's so important to, so some of these older firms, like sitting on boards, having a few people doing a few, investment, 3 or 4 investments. I mean, most of their board load determines how many investments they can make in a year.
And so when you look out at something like, Kleiner, sort of with the rebuild that they've had, do you sort of say, hey, new people, but same old thing?
And, I think, Mamoon's doing a great job, and Mamoon and Ilya are fantastic investors. And I think they will do, they will do amazing. Right out of the bat, they've done fantastic things. So I think, it's not fair to just pick on one firm, and think, I just think it's, it's like saying, will Nordstrom continue to do well, or will they overtake Amazon, right? Yeah. It's just like, it's comparing apples to oranges. I think these new models are like a tsunami, right? So they are just going to wash everything away. And it's almost like a winner when it's like no comparison, right?
So if you, whoever was be in charge of Kleiner, in charge of the rebuild, if they came to you and said, hey, Alex, what should we do to be relevant in this next decade of venture? We have this amazing brand. We got to rebuild our staff. What might you say to them?
I think they're relevant. And this is also, I just want to make sure that, look, I love all these firms. They're all friends of mine. And I want to make sure that, Peter Thiel loves to say this, is like, it's like competition is for losers, right? So YC never competed with Sequoia, right? First round didn't compete with Union Square, right? They were all, so most of the, and which is even exciting, like Entrepreneur First doesn't compete with YC, right? So it's almost all these models, they're so authentic, they don't compete. Right. And that's the thing. So in that Series A space, it's the same old players. That's why some people say, Alex, venture is not changing. It used to be Sequoia Greylock Benchmark, and it's been Sequoia Greylock Benchmark Excel. It's the same players. It's because, and Breeze and whatever, right? Mamoon and Ilya, the new Kleiner team, they'll do great, right? I'm just saying venture is so much bigger now, right? So it's just increasing the pie. It's not so much they're competing with them there. And then those funds are now, as I said, most of them are.
Right. But if they came to you and said, hey, we want to find an area where for the next 50 years we'll be defensible and we don't want to compete with anybody, what would you say? Hey, look at a studio, look at a platform, try to.
Which is, that's the thing is like, right? A platform is incredibly hard to build. Right. It's how many people can build a YC? That's the same thing. How many people could build an Amazon, right? It's like, it's incredibly hard. I have so many VCs come and tell me, it's like, Alex, a studio is the worst idea on the planet because just one startup is so hard to build. How are you going to build 10 startups or 5 startups, right? And a startup will always devolve into one great company. Right. If you get one breakout company, it will just, collapse into that one great company. And I was like, of course, that's the defensibility, right? It's like nobody in their right mind will build a studio because it's hard enough building one company, right? It's like, Elon Musk says it's like chewing glass and staring into the abyss, but tenfold over.
Right. So where would the next YC come from? Where would the next EF come from for talented people who say, hey, Alex, I'm looking to start a platform.
I think it'll be so authentic, right? It will look nothing like the same, right? And I've seen, I can't name names, but I've seen, people come to me and say, well, Alex, I'm building this new platform and has AngelList in it and has YC in it and it has, XYZ, and recent it and all rolled into one. And, they give up. They give up after 6 months, right? Because actually it takes a lot of commitment. That goes back to the missionaries, right? So the people who are actually doing this, and doing it the right way, they are super driven and they're authentic, right? The amount of content and, kind of what, like for instance, Jason Lemkin does, or, what Gary Tan does with startups. You couldn't pay people to do that,
And so you have something like YC that, lost Paul Graham years ago, now lost Sam, obviously has Michael and has a great team. 10 years from now, do you think YC is as powerful as it is today? Do you think accelerators are as big as they are today? Will there be competitors to YC or doing the same thing, or?
So, and that's a very, very good question. And I think, I think just YC gets stronger and stronger. As you know, and this goes back to the disruption theory. Yeah. People never get disrupted, from above. Right? So Sequoia is not going to disrupt YC. Benchmark is not going to disrupt. Yeah. They get disrupted from below, right? So if you look at Detroit, Toyota, now we have Lexus and stuff. Toyota was the worst brand, right? And they came in from below and they disrupted Detroit. Now they're getting disrupted by the Koreans, which again was there's always disruption. But, I think YC has such momentum. A very good scenario is I think YC will continue to be dominant in this space, right? On the space that they have, there might be other spaces, right? Which will, where there might be dominant players, right?
Do you think, continuity will be successful? And do you think YC should create a Series A fund as well? Or own the entire stack?
No, I think YC's continuity is already successful. So I think they're, they have amazing, things. Obviously, there is a thing, right? If YC raised $100 billion fund like Masayoshi-san did, then maybe they should be just all full stack, right? But I think their current model depends on, them not participating in at least certain rounds for the reason of signaling. There's always ways in which you can,
you could imagine them raising that much amount of money and being SoftBank for seed, basically.
Or seed through Series D.
Yeah. So let's talk about AngelList. What was sort of the promise of AngelList, and what do you think we've learned about sort of data-driven or, technology-driven venture investing?
I think Nawal is one of the smartest, most innovative people of this generation of investors. He called so many things right, and AngelList has been so massively influential in our space, and also so many AngelList alumni as well. I think, it's just kind of AngelList, and AngelList is also evolving. So there was AngelList 1.0 and then 2.0 with syndicates, and there's, they're doing 3.0 with their funds and stuff. Right. So it's, it's still an ongoing story. I think we have yet to see the most a dominant version of kind of a data-driven thing. I think there is no disrespect to anything out there. Nothing has kind of, will probably, that's another area of disruption. And I don't think it'll be kind of quote unquote machine learning driven. I think it'll be kind of, it'll be API driven. Yeah. It'll be APIs and SDKs. But as you know, there's a very, very fine line. There's some people who might try to do it, and there's so much issue about privacy, and startups are incredibly private. So if startups find out that X, Y, and Z is using, their data for something that was not meant to be, right? I think it would, they would, so it has to be done in the right manner. Right. But I think that's going to be the data-driven approach. And I don't think anybody is working on it, and again, that's because it's super, super hard. So that goes back to, why I like entrepreneur-led funds, because, entrepreneurs can build platforms. not VCs. Entrepreneurs can build studios, not VCs. And entrepreneurs can build API-based funds, not VCs.
Right. I like that framing. Why couldn't Sequoia or another firm have tried to build YC back then?
It's the same thing, right? Why didn't so I have this mental image, right? I have this mental image. There's this book called Losing the Signal, and it's about BlackBerry or Research in Motion, and the founder of he's a brilliant guy, so, and BlackBerry was so innovative, right? And they were always evolutionary. They were never revolutionary, right? So they always, instead of going to 4G, they went to 3G, instead of they always did, but they did the right thing, right? And so, they always conserved bandwidth, and so when he first saw an iPhone, he said, it's going to be a disaster. It's going to hog everything, hog all the bandwidth. And he was an engineer, of course, and he disassembled the iPhone when he first got it, and he was aghast. He said, they've put a Mac into a phone, right? And it's this thing where you do the unthinkable, right? You do something revolutionary. So I think that's what's needed, is doing something unthinkable, right? And when you look at YC, right? I mean, Sequoia would never do that because it's the unthinkable, right? You mean just like hire people with 6-minute interviews? Are you crazy?
Yeah. Or pick companies, yeah. Pick companies after looking at them for 10 minutes.
And then not be on the board and just give them money and then meet with them for office hours once, so it's unthinkable for, and they're fiduciaries, right?
Yeah.
And they're very, very good. They're very good at what they do, right? So it goes back to the physicists, right? So they say, whenever a new theory is espoused, they say the old generation of the physicists almost have to die before, it's that theory becomes commonplace. So it's the same thing. It's kind of sacrilegious to say some of these things that the new models.
I'm curious, what else do we think is going to change in the next decade, next 5 to 10 years looking at venture? We had Keith Boy on the podcast, and people were joking that he's sort of like Kevin Durant or LeBron James, going to the Lakers, or Kevin Durant going to the Warriors. And he was dubious that there would be sort of more of a free agent like approach to venture capital. What is your take on whether partners will move more frictionlessly?
I think picking will matter less, right? So I think stars matter less. I think now the opportunity is to change the game, right? So if someone is playing basketball, you come in with a tennis racket. So that's what I'm looking for, is the people who are coming in with a tennis racket to the basketball game, and they're changing the game. So
what do you think about scout funds and scouts in general?
I think that's probably the worst idea I've ever seen.
Please share more.
And I think, so I can tell you I'm opinionated. I think, one is, I think there are a lot of extensive models. I think most of the extensive models can be done very poorly. And so I think in these scout funds, and actually they've been around. If you go, Red Herring asked me about a scout fund that Charles River did in 2006. Okay. So they've been around for a long time. And I said it was a good idea. And so it took me a few years to learn, that I think in the scout funds, you're actually outsourcing, the things. So basically you're disrupting, unless you can build your own brand to do that. Right? You have your own proprietary brand. It's just like if Banana Republic have 3 different brands, or Gap have 3 different brands for 3 different segments. It's the same thing. If you could have, a seed funded brand for a seed, a brand for an A, otherwise if you're outsourcing it, you just lose relevance. You start moving up. It's the same. And then you get disrupted from somebody that's actually closer to the entrepreneurs, So.
And what do you say when you think about Sequoia's scout program that's been successful and found?
I think Sequoia is an amazing firm, right? And Sequoia, hats off to them. They have reinvented themselves and they have stayed relevant, right? So I think, in their segment, they have, just generally, the idea of scout funds. I don't know whether it's helpful at all, because most of the time the founders get confused as well. First of all, they're not getting the help from those firms, right? So if you have 100K or 200K from, just pick your top firm, right? As a founder, you're really disappointed because you're not getting the halo, right? And if then they don't lead your Series A, then nobody else wants to touch it. And it's like, XYZ is an investor and they're not giving you a term sheet. What's wrong with you, right? Well, no, they will do their pro rata. Okay. They will do their pro rata, but I get to be why am I the lucky one, right? So I think that's why I think it's, there's less and less of that, because now again, it's so noisy, but I think, the extensive models are really, really hard to put, I'm much more interested in the intensive models. So I think, the studio models are more intensive models.
What's the difference between extensive and intensive?
Well, a scout model, a platform are extensive models, whereas a studio is an intensive model.
Yeah. Now, you yourself have thought about how technology not only changes VC, but also changes the LP world. What is the latest there? Is there, an angel list for the LP world? Or what does sort of technology look like to disrupt or change how LPs do business?
Well, I think that's what we are building is I wouldn't call it it's not X or Y. I think we're building something really authentic, and it's both real change is when you bring both processes as well as technology to help them those business processes, right? So it's as much of a process change as well as it's so that's kind of what we're doing.
And what are you trying to build? Is it a social network? Is it
Actually, it's not the social network. Is just kind of the tip of the iceberg. But actually we're building workflow tools for LPs to help them to radically simplify the investment process.
Yeah. You saw sort of this, the change in terms of venture capitalists being much more transparent, much more open, much more direct. Do you predict that we'll see a similar change in the LP world? Because right now, often people don't even know who the LPs are, or don't hear from them directly. Do you think you'll see much more transparency in that world, or not really, just different?
I think probably not. I think most, and I think this we've seen this again and again and again. I see this when there's this people who don't know this world. They always think, right? This is the naivete. We said, well, LPs need to be really transparent, and venture needs to have liquidity. Oh, that's why I'm going to allow people to. The reason why institutional investors invest in venture is because they don't want the volatility of the public markets. They want things that are uncorrelated, right? So tomorrow we have, the trade war with China escalates or growth decelerates there, or, they steal all our IP and, and the markets are down by 30% or 40%, the companies that haven't gone public, the Instacart is not suddenly going to be at $2 billion, right? So that's why LPs invest in venture, because they don't want things to be correlated with the public market. So I think that's a kind of fundamental disconnect. People think I want LPs to have liquidity, or I want VCs to have liquidity. Well, VCs and their LPs, they don't want liquidity. They don't want, they want times where they can have liquidity, but they don't want perfect mark to market with the public market.
Right. Well, is it worth talking just about a macro, like the rise of the fund of funds? Have fund of funds done very well? When did they sort of become a thing? Yeah.
I think fundamentally, fund of funds are a very flawed model. So if you look at it, fund of funds have some really fundamental issues with them. A, they have fees on fees. B, they are way over diversified. And three, most of the traditional fund of fund model has been built on this notion of selling access, right? So I think those three things make it, so if you look back to, of course, there's some people that have been around for a long time. They've built amazing organizations. But if you basically go through in the last few downturns, right, maybe 50% of VCs go out of business, but 70% of fund of funds go out of business, so I think they're much more susceptible to kind of the ups and downs.
Do you think that some people have said that the future of venture capital is sort of these multi-asset firms that you have, and not just multi-stage, but Andreessen has a general fund, they have a bio fund and a crypto fund, and you had social capital obviously had different issues of its own, but you had them doing not only different stages within VC, but also public, hedge fund. What's your sort of comment on?
So I think this goes back to, so if you just project where we are, and this is probably very controversial, but if you look at some of the largest asset management firms today, right, you look at BlackRock and Blackstone and others, Apollo and they were built on the, a few different waves, particularly private equity and ETFs and kind of index funds. And so I think they will be just like Masayoshi Son created, $100 billion fund. I think even though, there's a lot of, kind of disbelief that this would work, but I think you'll probably see more and more of those, so I think there are more big tech companies now. I think that trend is just going to continue, and they're going to be larger and larger. So I think the opportunity set for venture is increasing. That's why, even that, like we talked about the firms, while they might get disrupted from one space, they will still continue. There will be some multi-asset firms within technology, right? So there'll be the pool is getting larger and larger.
It's interesting because some people are bearish on the future of the asset class because of things like one, the big four, big five not getting weaker anytime soon, or things like crypto, which if Bitcoin takes all the value there, that might not be interesting.
I give you an example. You think the big four are dominant. In 1929, AT&T was 29% of the public market. In 1972, people say, well, Amazon is 6% of NASDAQ. In 1972, IBM was 12% of NASDAQ, right? And we say, oh, well, Jeff Bezos is very rich. And Andrew Carnegie, in today's dollars term, would have been $400 billion, right? So people have been, the relative dominance of these firms has actually been decreasing, right? It was 15 years ago, there was no Facebook, right? 15 years ago, there was no YC. So you're telling me this, in 15 years from now, we will have Sequoia and Benchmark and no other top firms? No, there's going to be, there's going to be no firm competing with Amazon or no firm competing with Apple. I think there'll be, amazing new firms, just as I said, and there'll be amazing new entrepreneurs. There will be another Elon Musk, and there will be another Jeff Bezos and another Steve Jobs. And hopefully he would have a studio.
Yeah. How should we, if we should think about SoftBank or just more late stage private capital, what does that mean for public markets? How do you think that will change in the next 5 years? Will that trend only get deeper, or will that shift? Will people start going public earlier?
I think, I think Bill Gurley bemoans this fact. It's like, oh, well, companies should just go public early. And I think going public is a particular skill. And, there's amazing entrepreneurs like Kevin Hart has taken 2 companies, 2 out of 2 public, right? Was only one YC. I mean, how many? They've had 2,400 companies. One has gone public so far, right? Or maybe 2 now, 2, with PagerDuty and Dropbox. So it's, I think it's a skill. And, now that, it's so much harder to go public. that's definitely changed the thing. But that's why the portfolios are changing. And I think I don't see I don't see that changing anytime soon. So we can see. In fact, I don't have the numbers off the top of my head, but I think the number of kind of the mid cap stocks like have halved in the last 10-15 years, and the number of public companies is decreasing. So I think that trend will probably continue.
Totally. So again, and maybe in closing here, looking out at the next 5 to 10 years, what else should we expect for the future of venture capital, or what other controversial opinions might you want to leave us with?
Yeah, so I actually don't think that I want to be controversial for the sake of being controversial, right? Yeah. Or contrarian. I just like to think the things that I like to get conviction on. I can't help it if, they are not the things that others, are not things. So, I don't know, but I think it definitely won't be, the things that, most people are gravitating towards, right? So I think I think that's one of the reasons why platforms are so, powerful as well, is because some of the best ideas that we've had, they've come from things that were the worst, that seemed like the worst ideas, right? As I said, Airbnb was the worst idea that ever worked, right? Coinbase or Uber, their TAM was very small, when they got funded. So I think these new sectors or new ideas will be things that no one anticipates. I mean, blockchain wasn't something that folks anticipated, right? So
how do you think about crypto and blockchain as an LP?
I think like we have one overriding use case of speculation, and I think aside from that, I haven't seen any really good applications. I think it's still very, very early.
So you're not eagerly investing in any crypto funds just yet?
No, I think we actually had, opportunity to, but I think we could not, but once you miss the opportunity,
And how about, last question, biotech investing or life science investing? Have you, in terms of funds, have you looked there? Have you done there? Do you think that's different than standard VC or?
So, I think I don't, dabble in that. So I think, it's a very different space thing. And that's why you saw many of the firms that used to have a biotech practice and an IT practice, they shut down their bio practice and especially on the therapeutic side, I think there are now interesting stuff happening in computational biology. But, I think therapeutics is not something that, that I follow. Although there have been some good firms but it's very, very different than traditional tech investing.
Totally. You're just so interesting. I have to get last question. Do you think that there will be something like another ICO boom or just some version of crowdfunding that makes more and more people investors? Or do you think that was a fluke?
Did that make people investors? I don't think.
I think, I don't know. I think some people were investing in projects that maybe weren't investing otherwise, or certainly people that had crypto money and were doing it sort of.
Oh, got it. Yeah. I think, maybe it did. I think from that perspective, it's really hard for me to have a good opinion about that. So yeah, I was not that involved in that.
Yeah, no, totally. Well, Alex, this has been a great episode. For people who want to learn more, or do you have any last minute plugs or things that you would leave our audience with?
No, I think just, if you're, starting a studio, seek me out.
Excellent. Alex, it's been a fantastic episode. Thank you for coming on the podcast.
Thank you for having me, Erik.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.